Hello and welcome to the June 2022 Charter Hall Direct Quarterly Update. I'm Scott McLennan. I'm the Head of Distribution at Charter Hall. Can I start today by acknowledging the traditional custodians of the land on which we gather today, pay my respects to their elders past, present and emerging. Well, Q2 has been yet another interesting time for investors, with inflation numbers continuing to rise around the globe as the effects of the supply chain bottleneck due to the war in Ukraine and lockdowns in China weigh heavily on the cost of goods and services across all sectors. In our local market, the election in May saw a new Labor government elected with a renewed purpose to tackle climate change as a priority, as well as seeking to take a more leading role in managing Australia's relationships in the Pacific region. And this has been well received in the wider international community. There are, however, many challenges for the domestic Australian market and the new government to tackle. Domestic demand has risen as a result of the COVID stimulus, which has helped fuel inflation, hitting a 25-year peak of 6.2% this month. The RBA has been forced to respond with some of the fastest rate rises in our economic history in an attempt to dampen this demand and get inflation under control. Against this backdrop, we've seen continued volatility in the listed financial markets, with investors seeking safety in US asset classes such as treasuries, gold, and alternative real assets. This quarter, we've successfully closed our Wholesale Property Series Fund number 1, achieving an 18.4% total return since inception. Following the close of WPS1, we launched WPS2 in April this year. In other highlights, the direct business has completed over $1.5 billion in transactions for the year ending to June, led by strong performance with all the funds exceeding their MSCI benchmarks. On behalf of the Charter Hall Direct team, I'd like to thank you for your ongoing support. Now it's over to Julian Menegazzo, the fund manager of our direct funds, to provide you with an update for the June 2022 quarter.
Thank you for joining us for an update on the Charter Hall Direct Suite of Funds performance at the end of the June 2022 quarter. I'm Julian Menegazzo, Fund Manager for the Direct business at Charter Hall. The Direct business is part of the wider Charter Hall Group, which has grown to become one of Australia's leading fully integrated property investment and funds management groups, with over 1,500 assets and $79.5 billion in funds under management. Now, let's begin the presentation. I'd like to remind you that we are not able to provide financial advice. Today's information is an update on our funds and the market more generally. And if you have any queries that relate to your personal investment situation, we encourage you to consult your financial advisor and to read the product disclosure statement or information memorandum in full. The first slide in today's presentation outlines the size and scale of the Charter Hall platform, with over $79.5 billion of client money with exposure to a portfolio comprising of over 1,500 properties. The direct business now comprises of over $10 billion, or close to 15% of the money we manage on behalf of our investors. Wholesale and institutional capital is our largest source of equity, comprising over 70% of the money that we manage on behalf of our investors. The chart on the right shows the overall funds under management within each sector, with the office and industrial and logistics sectors comprising over 55% of our funds under management, with exposure also spread across listed equities, long WALE retail and social infrastructure. At Charter Hall, we remain disciplined in our investment approach, focusing on secure income profiles to high quality tenant customers with fixed annual reviews across investments portraying high underlying land values. I will now provide details on the direct team here at Charter Hall. Across the direct business, we have now over 20,000 investors with over 1,500 financial advisors. We have 6 open-ended funds for investment, providing investors and advisors investment options that best suit their clients. We have won 2 awards from Zenith and Money Management, of which the team are extremely proud. We now have 22 property experts across the direct business, including investor relations, funds management and investment management. The portfolio now spans across 134 assets across all major markets and property sectors. The team has completed over $1.5 billion in transactions. This includes both acquisitions and divestments. The investment team is constantly reviewing and curating the portfolio, looking to maximise returns for our investors. The new acquisitions completed and strengthened the direct suite of funds, providing an average lease term of 9.5 years and also benefited from a 99% occupancy rate. The funds have continued to perform strongly over the 12 months to June. You can see on the chart that the blue bars represent the Charter Hall Fund's performance and the grey bars show the benchmark at 11.6%. You can see here, and the key takeaway is that the direct funds, including DIF4, WPS1, LWF, PFA and DOF, have continued to exceed the benchmark over the last 12 months, with the lowest return, an impressive 12%, being DOF. This is an outstanding achievement and result for our investors. While short-term performance is important, you should be looking at property as a medium to long-term investment or 5-year plus investment term. So, how have these funds performed since they were launched over the medium to longer term? Well, I'm pleased to report that all funds across the direct business have exceeded benchmark across their respective launch date or since inception date, as you can see here from the blue bar. The reason that the benchmark or grey bar as outlined varies between funds is because it depends on when the respective fund was launched. Irrespective of this, you can see on screen that all the direct funds has significantly outperformed over a long period of time, which is an outstanding result for our investors. This is generally a 5-year plus time horizon, with all funds providing regular income stream as well as capital appreciation over the life of each respective fund. We also have 3 fixed life funds or legacy funds that are now closed for investment, being BW Trust, the Direct Industrial Fund number 2, and Direct Industrial Fund number 3, or DIF2 and DIF3 as we like to call them, with BW providing investors exposure to Bunnings hardware assets and DIF2 and DIF3 providing investors with exposure to the industrial and logistics markets. These funds have also performed strongly since inception. These fixed life funds do tend to, however, have higher gearing ranges, which have elevated their respective performance over time when compared to our open-ended funds. Irrespective of this, all of the direct funds have materially outperformed their respective benchmark since inception, which is a great result for our investors and one in which we are very proud. As mentioned earlier in the introduction, all properties were revalued across the Charter Hall portfolio, comprising of over 1,500 properties that were revalued over the quarter. This provides great insights into the market and valuation trends across each of the property sectors, including office, industrial and logistics, long WALE retail, convenience retail and social infrastructure. This includes the revaluation of 134 assets across the direct business. For the office sector, investment sentiment continues to improve, with the return to office rates increasing across all major markets, now averaging 60% of pre-pandemic levels across the Australian CBD office markets. Investment demand continues to remain for quality stock or prime office assets in the core markets of Melbourne and Sydney. This has been evidenced by several major transactions, particularly for long-leased assets with secure income streams. Whilst we did see capitalisation rate compression across the office sector, predominantly in Sydney and Melbourne, some markets are beginning to see market rental growth due to recent leasing evidence. We do expect pricing divergence between prime or better quality assets and secondary assets to continue as investor demand preferences the better quality assets in core locations. This trend is also playing out on the tenant demand side, with tenants seeking high-quality office assets to provide their employees with accommodation providing good amenity, health and wellness attributes, as well as sustainability credentials. Onto the industrial and logistics sector, there continues to be a high level of demand driven by strong market fundamentals across the sector, including low vacancy, increased demand from various sectors, including e-commerce, health and consumer staples, and a shortage of land supply or serviced land. Valuation growth across the sector was predominantly driven by the market rental growth thematic continuing to play out in the sector, and we believe this will continue into the short to medium and longer term. Across to long WALE and convenience retail, demand continued to be focused on assets with blue chip tenant covenants across essential services, including the major supermarkets, Bunnings, fast food retailers and service stations, and we witnessed valuation growth in this sector. This was driven by the continued demand across the various capital pools seeking to secure income profiles and across these retail categories. So we've talked about the fund's performance over both the 12 months and since inception period. What I will now show you is the movement in unit prices and how they increased across each of the funds over the quarter, with the returns driven by a combination of income on either a quarterly or monthly basis and capital appreciation. You can see on screen that all funds had an increase to their unit price across the open and fixed life funds, producing capital growth over the quarter following independent valuations across the entire portfolio in the direct business. As we move forward into the new financial year, we will continue to actively minimise risks where possible. The volatility in the Australian and global economy, combined with the well-publicised increase in bond and inflation rates, are heightening our focus on proactively extending lease terms with our existing tenant customers, lengthening debt facility maturities, and maintaining high occupancy rates across our entire suite of funds. Whilst there may be more volatility and variability across the short term, we are confident that as Australia's largest manager in commercial real estate, that we have the team in place to deliver continued results for our investors over the long term. In terms of transaction levels, they remain elevated, with 12-month transaction volumes to June comprising of over $40 billion across all three of the major sectors, well above the 5-year average of around $30 billion. You can see on screen the blue representing office, orange representing industrial and logistics, and red representing retail. Core high-quality Australian real estate remains in high demand across the market, with transaction volumes in line or in excess of their 10-year average. There is continued demand from sovereign and offshore investors and both domestic and high net worth private investors. However, we have started to see signs of transaction volume slowing across each sector as investors assess the changing economic environment in regard to rising debt costs. Despite this, Australia remains a highly sought-after investment destination for investors due to its transparency and strong tenant covenants, with a focus for offshore investors on the gateway cities of Sydney and Melbourne. At Charter Hall, we remain disciplined in our investment approach, focusing on well-located property, providing secure income streams to high-quality tenant customers with fixed annual rent reviews. This strategy benefited our funds through COVID, and we will continue with this disciplined approach. Over the June quarter, the Australian office sector continued to show signs of resilience. Jones Lang LaSalle, or JLL, who are one of Australia's largest commercial and real estate companies and market leaders in real estate services, completed an outlook research report over the June period, providing their views and took a closer look at some of the key themes shaping the office sector as return to office rates continue to increase through the COVID recovery. The office sector has historically shown its resilience through various economic and property cycles, and COVID is no different. The office sector will continue to play a key role in providing collaborative and innovative workspaces for organisations into the future. The trends influencing the office will continue to play out over the medium term, and JLL have outlined their observations into 5 key themes that they believe will influence the sector over the next decade. Number 1, return to work rates will increase back towards 70 to 80% of pre-pandemic levels. Return to work rates are currently tracking around 60% of pre-pandemic levels across most major markets, and that is showing improvement. Number 2, organisations will gravitate towards office assets with environmental, health and wellness attributes, and this is now playing out with the trend towards prime grade assets versus secondary assets. Number 3, rising labour, material and finance costs will reduce new development activity. JLL expects the commencement of new developments will likely be lower moving forward over the short to medium term. Number 4, technology and healthcare and education sectors will become important sources of tenant demand, and we'll see growth across these sectors. And number 5, finally, the next generation of workplace design will have a greater focus on collaborative and social space. So what does all that mean, and what is Jones Lang LaSalle's outlook for the office sector? Well, they are of the view that positive economic growth projections and strong levels of employment growth are all positive signs for the outlook for the sector. There have been positive levels of net absorption over the 12 months, continued employment growth with the unemployment rate now at a historical low level of sub 4% and prime effective rents forecast to recover over the medium term. The improving occupancy rates in office towers, positive leasing demand, continued flight to quality and next generation of workplaces will all be key drivers across the Australian office sector over the medium to long term. Please reach out to one of the Charter Hall team members if you would like a copy of the report. I will now move into providing an update across our direct suite of funds. Before providing an update, I just wanted to show you a video of an asset owned by our PFA fund. This asset is located at 40 Bundas Street in Canberra. Canberra now has the lowest vacancy rate across the major office markets, currently sitting at 6%. I hope you enjoy this video. This now brings me to an update on our PFA fund. PFA is open for investment and provides investors access to over 60% of its net income derived from federal and state government tenants. The fund also has access to other high-quality, strong corporate tenants, with the top 5 tenants representing over 75% of the fund's income. The fund benefits from a very high occupancy rate of 99%, well above the Property Council of Australia occupancy benchmark, and has a portfolio of over $2.5 billion of assets spread across the Australian office sector, with over 75% exposure to the eastern seaboard office markets, and provides investors access to a long-term weighted lease expiry profile of 6.7 years. The fund's investment strategy focuses on established or emerging office markets, with properties anchored by government or well-regarded corporate tenants. The fund pays distributions on a monthly basis. The fund has its regular 5-year liquidity event approaching at the end of August. More details around the liquidity event can be located in our quarterly report. Management will be writing to investors at the end of August, providing details on the liquidity event whereby investors can decide on their future investment within the fund. The fund does continue, however, and we know the majority investors will remain invested within PFA. Before I give you an update on our DOF fund, I wanted to share a video with you on one of the fund's high-quality assets, also located in the Canberra market. 25 Collishaw Street in Tuggeranong is a quality office building, and its major tenant is the Department of Human Services, a key government department with significant presence across this market. Please enjoy this video. This brings me to the Direct Office Fund, or DOF. The fund is open for investment and is the largest fund across a direct suite of funds at close to $3.3 billion in size. DOF's investment strategy focuses on core CBD and established and Australian office markets, with 94% of the portfolio weighted to the eastern seaboard office markets and over 70% weighted to the highly sought after Sydney and Melbourne markets. The fund's top 5 tenants comprise of close to 60% of the fund's overall income, benefiting from over 30% from federal and state government, as well as exposure to the Western Sydney University, Coles, Suncorp and Westpac. The fund benefits from a very high occupancy rate of 97%, also well above the Property Council of Australia occupancy benchmark, and has a weighted average lease expiry profile of 7 years. The fund pays distributions on a quarterly basis. The Charter Hall Direct Long WALE Fund, or LWF, is our diversified fund, also open for investment. The fund provides investors with exposure to a diversified portfolio of assets. LWF provides investors to a portfolio of over $500 million with a focus on resilient property sectors, including industrial and logistics, office, long WALE and convenience retail, and social infrastructure. The top 5 tenants comprise of close to 60% of the fund's income, benefiting from federal and state government, Bunnings, who dominate the hardware market, and Coles, who are one of Australia's leading supermarket operators in the retail market. The fund benefits from a strong 8.7-year weighted average lease expiry profile and 99% occupancy rate. The fund focuses on highly regarded long leases and structured rental increases and pays distributions on a monthly basis. LWF was active over the quarter, acquiring 3 assets. The first, 32 Mann Street in Gosford, is a modern, high-quality office building completed in 2019. The A-grade office building provides a secure income profile to the New South Wales Government and favourable annual rent reviews. The property also benefits from strong environmental credentials and is located in a key employment growth corridor. The other 2 acquisitions were 2 newly constructed social infrastructure assets located in Robina, Queensland. The property's income are underpinned by long-term leases to the Queensland Government and a medical user. Both are tenanted with 10-year lease terms with fixed annual rent reviews above 3% per annum. The acquisitions were also undertaken off-market. Before providing an overview on DIF4, I'd like to provide just a brief update on how rental growth is playing out across the industrial sector. Strong rental growth has continued across the sector, driven by high rental demand. You can see from the slide on screen, the blue bar shows the rental growth across each of the sub-markets across the Australian market, and the grey bar shows the 10-year historical average. Over the 12 months to June, the national rental growth rate is over 10%. The rental growth story is expected to continue across the sector. This is being driven by strong market fundamentals, including low vacancy, shortage of development land, and leasing demand across the sector, including e-commerce, health and consumer staples. I would now like to show you one of DIF4's high-quality Australian industrial and logistics properties. The Port Connection Distribution Centre, located in Queensland, is tenanted by Kmart and is their main distribution centre in Queensland. The asset is valued at close to $200 million and is DIF4's largest asset. I hope you enjoy this video. I will now move into providing an update on our Charter Hall Industrial Fund Number 4, or DIF4. The fund is close to $2.8 billion in size, comprising a portfolio of 55 industrial and logistics assets. It has 100% occupancy and a long 10.8-year weighted average lease expiry profile. The tenants across the industrial and logistics centre tend to be larger than the other sectors, spread across more assets. You can see up on screen the quality of the tenant customers in DIF4, the likes of Bunnings, Kmart, Visy, Mainfreight and SPC. You will also notice that the fund does not have more than 10% income exposure across any one tenant, providing beneficial diversification of income across the fund. The fund has benefited from the strong market fundamentals within the sector. Over the quarter, DIF4 acquired a Bunnings located in Albury. The asset is situated in an established area within a strong trade area. The essential services non-discretionary spend has demonstrated to be resilient both through COVID and in a post-COVID environment. The acquisition builds on DIF4's existing allocation to Bunnings, now at around 9%. The asset has beneficial weighted average lease expiry and is 100% occupied by Bunnings. I'd now like to introduce our guest speaker for today, Stephanie Petrevski. Stephanie is a specialist in the industrial and logistics sector with over 10 years industry experience. She oversees performance of facilities and property management teams along with asset value creation across a combined value of $1.5 billion in the New South Wales portfolio. Stephanie is an active advocate for women in the Industrial and Logistics Centre through Women in Industrial and Mentor for Girls in Property. We're excited to hear about one of the assets she manages for DIF4 at the Connect West Industrial Estate. Welcome, Stephanie.
Hi, my name is Stephanie Petrevski, an asset manager in the Industrial and Logistics team. Charter Hall's Industrial and Logistics team partners with Australia's largest and most trusted businesses and global brands to develop, own and manage next-generation industrial and logistics facilities custom designed to meet customers' businesses' needs today and for the future. Our property footprint nationally and specialist expertise locally means we are uniquely positioned to partner with our customers to create a better, more connected and productive future for their businesses. We bring our customers' business aspirations to life through innovative property solutions, expert asset and property management, and unwavering commitment to quality, sustainability, and business growth. Charter Hall proudly has the largest national industrial and logistics footprint and development pipeline in Australia, with 297 properties totalling 6.4 million square metres of total GLA and a $5.8 billion development pipeline. With over 90 industrial and logistics specialists on the ground in New South Wales, Queensland, Victoria, Western Australia and South Australia, we are the largest industrial and logistics team in the country. Today I'll be talking to you about one of DIF4's assets located in the Connect West Industrial Park, a large industrial estate predominantly developed by Charter Hall, 16 Kiln Street, Darra in Queensland. This facility is a purpose-built truck servicing and sales centre for the Daimler Trucks business. This facility will form a critical component of the Velocity Vehicle Group National Growth Plan and will allow the business to grow and expand their truck services and sales operations throughout Queensland. The site was developed by Charter Hall and was acquired off-market by DIF4 upon practical completion in September 2021. On completion, the asset was fully leased, 100% income producing with a property value of $46.8 million. The gross lettable area comprising of warehouse, workshop, showroom and office totals 10,703 square metres, which is situated on a large site area of 33,855 square metres. The asset provides for a secure income stream having an initial 15-year lease term with the starting rent of $1.8 million to Eagers Automotive being utilised for the Daimler Trucks business. Eagers Automotive is Australia's leading automotive retail group in Australia and New Zealand with a market cap of $3.2 billion. The key features of this asset include full drive-around access, purpose-built truck workshops and part storage facilities, and market-leading sustainability credentials. This asset forms part of the wider Connect West Industrial Park, where DIF4 owns an additional 3 assets alongside the Daimler Truck facility. This acquisition provided the fund with the opportunity to acquire a new, high-quality, A-grade logistics and warehousing facility situated in the key industrial precinct of Darra, leased to a key tenant customer with a WALE of 14.2 years. The property is situated within the Connect West Industrial Park, located in the core commercial and industrial South Brisbane precinct of Darra. The site is strategically located approximately 17 kilometres by road southwest of the Brisbane CBD, 33 radial kilometres from Brisbane's airport, and 40 kilometres to the Port of Brisbane. The estate benefits from direct access of Ipswich Motorway, being in close proximity to Brisbane's key population growth centres, along with excellent access to Centenary Way and the Archerfield Intermodal. The location has also benefited from the Queensland Government delivering a record infrastructure investment of $49.5 billion over 4 years to 2023, which included $23 billion for public transport and roads. The acquisition was in line with DIF4's investment strategy, providing investors with access to a high-quality industrial asset comprising a secure income profile with an initial 15-year lease with fixed annual rent reviews to a strong tenant covenant. The asset was secured off-market, providing access to a high-quality industrial property strategically located in a core industrial estate, and the asset acquired brand new on completion increased the quality of DIF4's portfolio with market-leading sustainability credentials. This property is a great case study of how we're able to access off-market opportunities and demonstrates the high-quality assets DIF4 investors are able to access across a diversified, sector-specific industrial and logistics fund, $2.78 billion in size across 55 properties in key industrial markets.
Thank you for those insights, Stephanie. The next fund I will talk about is the Wholesale Property Series Number 1, or WPS1. The fund has delivered some outstanding results for our investors, providing investors with a 12-month return to June of 19.3%, significantly outperforming the benchmark. The fund provides a long weighted average lease expiry of 9.8 years, high level of occupancy at over 97%, and also provides investors exposure to a diversified sector property allocation. Unfortunately, however, the fund is now closed for new equity. We have recently launched our second Wholesale Property Series, the Wholesale Property Series Number 2, or as we like to call it, WPS2. WPS2 was launched in April and is now open for investment to wholesale and sophisticated investors. The fund provides a long weighted average lease expiry of over 12 years, high occupancy over 98%, and also provides investors to a diversified sector of allocation that we believe will add the most value for our investors over the term of this investment. The next allotment date for WPS2 is the 17th of August, and the fund has a minimum investment of $250,000. If you are interested in this fund, I encourage you to read the information memorandum or consult your financial planner to understand the risk and structure, as this is a little different to our other open-ended funds. WPS2 provides investors exposure to a high-quality tenant customer profile, with the top 5 tenants comprising of over 60% of the fund's income, with household names including Telstra, Bunnings, David Jones and Coles. WPS2 provides investors exposure to a diversified sector of property and allocation across the core real estate classes, including industrial and logistics, office, long WALE retail and social infrastructure, and has access to Charter Hall's wholesale fund and partnerships, providing investors access to some of the highest quality assets across the Australian real estate market. The next fund is our Maxim Property Securities Fund. This fund is a little different to all our other funds as outlined today, as it invests in stocks traded on the ASX. In line with the recent equity market performance, over the 12 months into June, Maxim delivered a total return of negative 12.5%, slightly below the fund's benchmark return of 11.2%. Over the longer term, which is extremely important, the fund has delivered solid performance, returning 10.8%, which is above its benchmark of 9.5% per annum. The key detractor over the past 12 months was an underweight exposure to the discretionary retail sector, whilst overweight exposure to seniors living and rural property assets. Alternative asset classes continue to be favoured, characterised by long leases, strong tenant covenants and resilient earnings. The prospects for the sector are positive given the strong demand for industrial facilities, return to office and sizable share price discounts to underlying asset values. Finishing up the funds update today, I will now cover the fixed life funds being BW Trust, the Direct Industrial Fund number 2 and Direct Industrial Fund number 3, all 100% occupied and with strong weighted average lease terms that have performed extremely well. The liquidity events are outlined up on screen. The next liquidity event relates to DIF2. The management team at Charter Hall will write to investors to update you on the fund and fund strategy. Thank you for joining us today. If you would like more information on all opportunities currently open to investment, you can visit our Advisor Resource Centre at charterhall.com.au/advisors or contact one of our team. Thank you for your ongoing support at Charter Hall.